the portfolio will kind of talk about this, but essentially all the edge in zero DT, it comes from what's called arithmetic versus geometric mean. And basically what that is like when you compound like $100 a day, like you just make $100 a day statically. That's called a arithmetic mean. So make $100, make $100, make $100. At the end of the week, you have $500. But then there's basically what's a geometric mean, and that basically means that you make like 100, 101, 100, 150, and then that just continues to be a bigger and bigger pot. And also, like, you can have trades that don't really make money, but it prevents you from losing. Like, you only lose $200 in a day.
Yeah.
And lose like 800, and therefore that compounding just keeps going. So you're literally just playing like this basis point math equation times, 1,000.
That's what I got from your NAV talk. You talked a lot about that and that was making sense. I was understanding, like, you're talking about, the benefits of zero DT is like, I saw it was compounding and, being able to maintain your edge and rebalancing. That's what it was. It was compounding and rebalancing. That's how we're like able to basically be better than the competition and just traditional hedge funds.
Yeah. And like, basically, if we can make 1% a week and we never take a hit bigger than like 10%,
yeah,
what I say is we'll aim for 5%, but we're going to get more than that just because we're not going to execute like that. And we just know we can actually execute our back test. Like, you're doubling your money every year and a half at a 30-something% rate of return.
That's wild.
And that's really going to start to pick up. So everyone's trying to find like these magic strategies or whatever it is, but it's like, I'm trying to show people this is like the buy and hold of the S&P, but with options.
Yeah.
And do this through doing it every day with 0-day duration. And then we can actually quantify what our risk is, plus or minus, $30 in slippage for some days on a day-to-day basis. And therefore we can now leverage money. So as long as we're responsible, we can leverage more. Whereas everyone just looks to leverage first, not leverage responsible.
So a great example of this, like yesterday I was talking to a family member and they were talking about how somebody, took 100,000, put it in a video and they won, they got like 250 out of it. And I was like, oh, that's great and all. But since me and you talking about it, I feel like a lot more educated in the sense of like, that's great and all, but he could have also lost that 100,000 because Nvidia could have just dropped. He could have got in at a bad time and it just plummeted, and then he would have just lost his bud on that. Rather than if you do something like 0-day, where you're like we talking about, we're just continuing doing data back. In a year and a half, he could have had 30%. He could have gained 30% of that. In another year and a half, it would have been another 30%, and you just continue investing money in that.
It's income, it's different, because like, speculative. I don't want to call it speculative, especially like if he's buying stock, that's really not that speculative. Whereas buying an option on Nvidia, that's speculative. So those are two different things. But yeah, that's basically the cadence, is like we're just slowly chipping away, and like we can automate this, and the data is relatively clear. And if we do it every day, we'll basically get there.
Well, I guess what my point of that is, if I was an investor and if I'm going to invest my hard-earned money, I'm going to much rather invest it in something like 0-day because it's so data driven, rather than speculation of saying, oh, Nvidia is rising. I think it's going to rise to 1,000 and it's at 500 now. I just gonna dump my money into it and see, like, not saying that you can't make a little bit of money in this, but this seems like not guaranteed, but just makes a lot more sense rather than just doing normal stuff.
Yeah. And the other thing too is like a lot of investments have a very long time frame. So like in 0DT, we're going to know if we're good or not in a couple months, because there's it's rolling over so much. Whereas a lot of people will buy like real estate, or they'll just buy the NASDAQ. And that strategy has worked amazing since 2008. And every time it goes down 30% in 2022 or 2020, it rips back.
Yeah.
However, like that time frame is just really long. And like between 2000 and 2009, granted, that's kind of cherry picking like the top of the dot-com bubble and the bottom of the 2008 crisis. But at the same time, like you lost 35% after inflation over the course of that decade. And it's like, people don't remember that far back, or people don't remember like when everyone lost their ass in real estate. Because in real estate, if you buy a bad purchase in real estate, it's like, it's going to take probably a decade till the market rolls over to that actually being bad.
100%. Yeah.
So people think they're smart and they do this, and then they use leverage and they get hit. Whereas like zero DT is the opposite of that. Like you're going to get instant feedback and you're going to use leverage that's going to amplify the pain or the pleasure. So it's like, it's the deep end of investing, but once you can swim, you can get across the pool.
Yeah, like I look at it as like back testing is what really takes it to a whole nother level of investing, because you can say like, here's the data that some like I feel like everybody would be a lot more willing to invest in stuff if like you had a back testing for real estate, if you had back testing for all this stuff.
Yeah.
Like back testing is like, hey, I can practice this, I can like you were talking about, break this down, not make manufactured edge, but just continue to add more miscellaneous into it, so it's an actual true edge. We can see what the edge really is going to look like, and like I think that's what really stands us out. But yeah, man, I think that listening to those really helped me understand like what you're talking about. We're going to dive into back testing today, understanding like there's a reasoning behind like each number that we put in. There's a reason why you put in slippage to, I think you said you only do like a 1.5 in slippage and you only do one trade lot and stuff like that. And didn't remember your reasoning behind those because there's just a lot to take in, but like it makes sense that we're acting out of reason in everything that we're doing,
Yeah. Okay. So let's get you kind of set up with what we'll be doing here. So we'll basically have you get rolling on this.
Yeah.
So like first step is we'll kind of just go over zero DT and stuff. So I am going to have you back test different amounts of premium. And the first thing I kind of want you to understand is that basically this is calculating the expected move at zero DT. So basically it'll show a couple metrics. It shows the S&P 500 price, or the SPX, shows the SPX expected move, which is how much it could go up or down. That's basically the only variable that's not known that prices the options, which is implied volatility. So this is effectively what we're selling when we're selling credit. Then we have the VIX, which is a rough proxy for the volatility, but it's calculated on a 30-day period. So we don't give a huge barometer to that. And day to day, based on what's happening in the market, the EM could be priced over that. Then we have the total out of the money options price, otherwise abbreviated at OTM options price. And that's basically saying the value of all the options throughout the course of the entire day. And it gets updated. And then we have the expected moves. It has here one standard deviation and two standard deviations. The one standard deviation move reflects what will be within 68% of occurrences, and the two standard deviation move reflects what's within 95% of occurrences. So I know we're choosing like $1 premium, $2 premium, and it probably doesn't make sense why we sell that or why the data comes up in certain ways on backtest. So this is a really good way to basically iterate what that looks like. So if we look here at the market open, the expected move was between 54.79 and 54.40. However, over the course of the day, like if we look now at 1:20 Eastern, the expected move is now 54.77 to 54.41. So it's basically not changed the entire day, but you can see here that the price at the open was 54.60 and the price now is 54.54. So basically this shows throughout the course of the day that when we sell premium at different times, we're just creating more occurrences and balancing out the level of what's going on. So like volatility could be overstated from the open till the close, in which case we're going to lose on our open trade with our stop loss. However, if we caught the high or the low just kind of randomly when we were selling additional trades, volatility can be overstated from the open to the close. But from the time we entered in at 11 or 12:30 or whatever that is, it could not be overstated from that period forward and we could win. And this is why, going back to the concept, we're going to choose what's called a credit target. So if we sold, a 10 delta, which is the 10% chance at the open, since there is $63 of out of the money options price, we may get $1.50. Whereas at 120, like now that there's only $22 of option price, we may only get 50 cents. So basically we lost on the open trade and then we won on the trade at 130. We could have matched the probability of 10% when we ended up losing money. So we're basically going to choose like $1 or $2 and whatever we do that through back testing. And we're just going to use a stop loss on it because a trade at the morning, the market may have to move 20 points for it to get stopped. But it's not going to be something we hold to expiration. The heat on a move that we get up or down by 10 points is probably going to be relatively similar throughout the course of the day. So we're basically seeking to try and find like some premium, whether it's $1, $2, $3, that works basically at all times throughout the course of the day. And then that has a relatively same win rate. So if we were to sell 150 at the open each side and we sold 150 at noon on each side, let's say they both roughly have a 75% win rate. That's perfect. Whereas if we sold $3 at the open and it had a 75% win rate, and we sold $3 at one and it had a 65% win rate, we don't want to do that. So we want credits to match, win rates to roughly match. And then we're going to get the rudimentary data from this free backtesting software that anyone can basically use. It's for a zero DT automation. So basically, what you're going to do is you're going to click, I'll send this to everyone. You're going to go to build your own backtest. And then basically what you're going to do in here is we'll just get the rudimentary data here. So we'll start out with 1-1-2020. And we'll basically go to today. We will exclude FOMC meetings. Basically here, this is our target premium. So we're just always going to use a max. Okay. We're always going to use 100 wide spreads.
Yeah.
And then basically what I want you to do is I want you to go from $1 all the way up to 250. Okay. And you'll go in 25-cent increments.
Yeah.
And basically what you'll do is you'll test all a 2x stop, and then you'll test them all at 933. Okay.
All right.
So basically this is a fixed contract. You'll just put in 50 grand because that's the size of your account. We're using $2 for commissions, $1 for fee. Open slippage will be 10%. Closed slippage will be 15. Okay. And then basically all you have to do, and then we're going to do this by puts and calls in both. So you'll just record this in an Excel spreadsheet. Let's say you go calls, you click run test. And then basically you'll just record win rate, PCR, and max drawdown. Okay.
Yep.
And basically what you'll do is, so that was 250. You'll do, let's say $2, run it. And then again, you'll record win rate, PCR, max drawdown. And you'll basically do this from 250 to $1 going down by 50 cents. You do it separately for calls, separately for puts, and then you'll do both, which would be the condor. So if we did this for the condor, boom, and then you'll record this. So basically,
go down by premium on starting at 250 all the way down to obviously do like 50 cents, right? Stop.
Yeah. And then you'll do all the call side, all the put side, and then you'll do both of them combined together. And then if you want, you could do like a 1.5x and a 3x. So if you wanted to do that on all 3 iterations, that'll be good. And you'll just record the numbers in a spreadsheet. Okay. So just in Google Sheets. And then once we have that information, this one goes quick. We'll kind of be like, okay, we want to sell $1.50 at the open on the put side and $1 on the call side. Then we'll take that input options omega and we'll start to test more particular ranges, and the backtest just takes longer and we'll get a little bit more granular data. So once you do this, you can kind of understand not what's the best trade, but what's the best trade that works over periods of time. So you may see that you'll sell a $2 put, like a $2 put is the most optimal and a $1 call is the most optimal. Yeah. However, it's a condor. If we sold a $2 put and a $1.50 call, that actually gets us the best return. So this is
this one, that's what we're going to do, because this one, it doesn't really have the condor, but that's what we're going to do in options omega is what you're
when
saying.
You have both, it's trading it as a condor, but yes. So call spread, put spread, both as a vertical condor with both of them. And once we have the data of what works on each side, we now have the initial building block to decide, okay, we know what's most optimal on the put side. We know what's most optimal on the call side. Now, what combination of the premium we collect on the put and the premium we collect on the call makes the best condor?
That makes sense.
It's probably basically going to be the same, but now we know what the risk is for that. Then once we have that trade, we say, this is our 930 trade. And then from that point forward, we're going to say, okay, do these same premiums that we collect work at 10, 11, noon, 1, and 2? And then we're going to kind of see which condors work best at those times. And then we have the other building block of those other trades or what premium works throughout the course of the day. And then we can say, okay, how do we want to allocate our portfolio? So again, back to sports, this is practice. We're taking shots. Then we're going to start taking shots in a game after we do this. So this will basically give us the initial intro to what we're looking for. And then we'll go ahead and program this in Trade Steward. And then we'll basically come in here every day and just type, today's the 25th. So we go 6/20. Well, this won't show up because it was 23, 20, 24. And then we would basically show that and we could run it. And then we just come in here each day and we say, okay, on Monday, the call lost. And we say, does this match what popped up in Trade Steward? And then all of a sudden we've made the building blocks, we've made the portfolio, we have our assumptions, we measure our assumptions daily. If they're off, we iterate on it and we keep on going. So what people often will do is they'll put a trade and then they'll see it has a good return for like 4 years. And then they'll start running the trade and they'll just be like, I'm not making money. Fuck this. I'm going to find a new trade. Well, we don't care about that. We just want to match what the trade is. So we're not necessarily going to find what's been best the last year. We want to see what's worked for a long period of time. And then, here it'll show like max days to recover from like your drawdown. So like if we do a test and we see that outside of the COVID crash, because the COVID crash is probably going to be, we could kind of eliminate that because that doesn't happen very much. It's good to know, but so once we know that, we can basically be like, okay, this strategy could potentially lose for 60 days in a row.
Yeah.
So I'm ready to run this for 2 months. And as long as it matches the back test, like I'm all good. And that's
it's going to come back eventually, right?
Yeah.
Start winning.
The important part is that we're working out, not that, and we're tracking our progress, not that we're getting a six pack. You know what I'm saying?
Yeah.
Okay. And then do you have any questions particularly around this, or does that kind of empirically make sense?
That does make sense. Yeah.
Okay. To get the raw data, which is eventually going to lead to building a portfolio and automating it live.
Yeah, that makes sense. And for the purpose of just this, are we just trying to figure out what condors to build? Or are we also figuring out, hey, maybe the condors though, because you've shown me in the past that the condor is not the best method either. So it's like we're figuring out maybe we just do, sell a put, so buy a call type thing,
So that's why we're testing the put side and the call side separately and then them combined. Because if the put side by itself makes just as much money and has less of a drawdown or less days between new net like highs, we're just going to use the put. You know what I'm saying?
Because it's less risk, right? Yeah.
Yeah. I mean, there's no point of selling the other side if it doesn't help us.
Makes sense. All right. Sounds good. That's why. So this is us figuring out all of that basically.
Yeah. But most likely what I would assume, the puts are going to outperform the calls. So these 3 time slots will probably all be condors. And then we'll probably add in a specific time that only sells a put. So that will be more how we balance it out rather than deciding whether we do a put or a call. You know what I'm saying?
Yep. Sounds good.
But the more important part is we would potentially sell $2 on the put side, $1.50 on the call side, like something like that. And that would make a better condor. But it's almost, since we're trading it every day, I can guarantee you I've done like a million back tests. It's going to make sense to trade the call.
Makes sense.
Yeah. If anything, even if it doesn't make money, it'll reduce our max days between new net like highs. Because if you're doing a put and a call, the price of the market can only be in one place at a time.
Yeah.
So when you're losing on a put, you're most likely winning on the call. And then sometimes you'll win on a put, but you could have won on a put and or call. So that's kind of going to be why it works.
Makes sense. Makes sense.
And then did you have any more questions or you make sense on the?
Yeah, this makes sense. Yeah, this is kind of putting it all together, understanding like the reasoning behind the trades and how do you figure out what to trade and, what do you figure out what even to put into options Omega. So this makes good sense.
Perfect. Okay. I think that was pretty good.
Awesome, man.
So I'm going to stop this.